We will talk about tokenomics.
Token economics is the basics of crypto startups.
Every startup is unique. Business model is unique.
To be a co-founder is absolutely hell.
How do you find valuation of the tokenized startup?
In most cases, it's actually bullshit.
Healthy motivation for the team members in tokens.
I think that it's a must for every project.
Estimate properly the value of their tokens.
Always spread the unlocking as much as possible.
We keep some part of our allocation for the top VCs.
Many of the investors in crypto will decide on an investment based on the cap table.
All of them are very sweet guys before you sign this up and give away allocation.
We have so many investors that are calling themselves investors, but they're not real investors.
These kind of things, they're kind of not common to discuss.
That's exactly the type of investors that you don't want.
Still, even me started to understand these things after several epic fails.
You do lock the tokens.
Good day to everyone. This is InnMind channel with the best first-hand information for startup founders and tech entrepreneurs. And today, as promised, we will talk about tokenomics. And even more, we will talk about how actually to approach tokenized startups. Since the beginning of this year, we had a lot of deal flow, which is non-traditional, let's say so, with a lot of crypto blockchain startups and also startups from traditional sectors tokenizing their business models. And there are so many questions about how to approach it. So the best way is not to make video by myself, but I decided to invite one of the most knowledgeable and people with the great reputation, On Yavin, who is founder and CEO at Cointelligence web portal, and also Cointelligence fund, the recent fund which invests in blockchain tokenized startups in gaming sector, play to earn concept. Hi, On.
Hi, Nadi. Thank you for having me.
Thanks a lot for accepting my invite and recording this video on Sunday. There are so many questions where you could really help. And first of all, I'm super grateful that you spend this time because, you know, while preparing to this video, I was Googling and I found so many content about tokenomics by various experts who call themselves experts. And the more I was listening to these videos or reading these posts, articles and advice, the more questions I got. So I really have a horrible headache in understanding how difficult it should be for common startup who does not have the contact of On Yavin, for example, or who does not have some friends who really understand this, how difficult it is to dig into these specifics. So let me straight away jump to the questions. And the first one would be, how would you say that tokenomics refers to the traditional startup world? In traditional startup world, we have business plan, financial model, financial planning. So tokenomics is more like business plan, or it is something different?
So yeah, you can say that parts of tokenomics has a lot to do with business. But I would say that token economics is maybe much more similar to financial economics or financial theories and so on. But I would say that if we compare it to the traditional space, so there's a huge difference. The first and foremost important difference, in my opinion, is the fact that with everything with regards to tokens is based on the concept of liquidity. And I have to say that it's not always the case, even though sometimes it's being said, because in some cases there's no real liquidity. In some cases, the planning was not done right. In some cases, the startup was relying on specific crypto exchanges that are not yet operational. If we are talking about security tokens, for example. But the future is very bright, in my opinion. And liquidity is the first and foremost important part about token economics. It means that if you tokenize your crypto startup, then you are supposed to allow your investors and everyone in the ecosystem to be able to sell and buy, to trade the tokens. And you're supposed to have 24/7 liquidity and 24/7 possibilities of crypto exchanges. But again, it's in theory at the moment in some cases and not practical. The second most important difference, if we compare it to the traditional startups, is the fact that token economics is the basics of crypto startups. It's always the case. If there's a crypto startup and they don't have token economics, then it's very rare that it's okay. But in most cases, you have token economics. And it makes such a huge difference when we are comparing to the traditional startups, because it's another mechanism that we didn't have before. So it makes things much, much more complicated. Because until today, for example, if we look at the crypto startups as investors, especially when you are investing in tokens, then the success of the project has a lot to do with the token economics. In the traditional startups, you don't have that part. So you have other factors that are very important, of course, but you don't have this whole factor. And that factor makes crypto startups much more complicated. And if everybody knows that startups are doomed to fail, crypto startups are doomed to fail even much more.
So I will definitely come back to this point, how the success of the crypto startup relies on tokenomics a bit later. So if we speak about tokenized startup, not tokenized yet, the traditional startup that is planning to tokenize their business model, or the new startup in the crypto space who wants to get tokenomics done, what should they start with? And what questions should they answer before starting actually designing the tokenomics?
So first of all, the most important question is if it's actually needed and if it's actually relevant, because many are doing it because of the hype, because of the FOMO. And in this case, it's a negative FOMO. And that's before anything else. Now, in some cases, of course, if someone is a CEO of a company, for example, and they don't understand anything about blockchain or cryptocurrencies, that's fine. They should take the proper advice from real experts. And when I say real experts, I'm talking about the fact that a lot of experts, many experts in our industry, are pretend to be experts. Exactly like during the ICO craze, we've had, I don't know how many, thousands, tens of thousands, maybe even more of ICO experts that were advising ICOs, while many of them didn't have a clue about startups, didn't have a clue about blockchain or cryptocurrencies, and they just advised in order to get paid. So one should be very careful about these pretend to be experts. But let's say that you are consulting with a real one that can actually help you, then you also need to make sure that that expert is advising according to what's needed and not according to his or her personal agenda. And I've seen it happening again and again and again. Just a small example, sometimes advisors just want to get tokens because they want to sell them as fast as possible, and they know that they can make profit, and they don't care about the project if the project fails very quickly, or if the company spends so much money to try to tokenize the company or tokenize a part of the company. And that's before anything else. Now, moving forward to the real answers for your question. So first of all, we should always consider the benefits. If we are tokenizing anything, we have to make sure that it has real value. Because sometimes if you tokenize, it's not going to help anything or anyone. The second part, the second answer is when you do consider tokenizing, you have to make sure that when you do the planning, you don't violate any laws. And I've seen it happening again and again and again. And we've seen during a few crazes in the industry that people are completely ignoring regulation. Just to give you one small example, just so our listeners will understand that it's still happening. It's not only during the ICO craze, it's still happening until today. I was talking to a potential investment project. It was a week or 2 weeks ago, and I'm talking to that specific lady, and I'm asking her, why aren't you on the presentation of the startup? And she says, oh, I'm sorry, I can't be on the presentation because I'm based in China and it's against the law. So I'm asking her, so you expect me to invest in you while you are acting against the law and you have no issue with it? But she said, oh yeah, it's not a problem. As long as I'm not on the presentation, it's completely fine. I say, oh, really? I understand. So, and by the way, and they are getting investments, just to be clear. They will be fully invested by investors. Maybe they are already are. But I'm saying that's just as an example. And it keeps happening again and again and again. And investors also keep investing in these projects, even though they know that they are acting against the law. So that's, in my opinion, the second most important part. And the third answer is that when you are tokenizing, you have to remember that you do need a few important parts during the tokenization process. One is the legal part that I just mentioned. Two is the financial part of it. As I mentioned before, it's all about economical planning, and it has a lot to do with financial economics. But the third part is the technology relations to the first two parts. And most people don't understand it, because you can tokenize and you can plan tokenization as much as you want. At the bottom line, it needs to work. And if you can't make sure that tech-wise you're going to be able to make it work, then there's no reason for you to do it. So if you have these three parts, you should consider it seriously. If you don't have these three parts, don't even bother. Don't even go there. And obviously, on top of these three parts, there's a few dozen of other parts that you need to consider when you're doing the planning. But these three parts are the most important as the basics.
So first of all, about tech part, I think it would be the easiest to answer. What do you mean? Please elaborate.
It's about the infrastructure. It's about being actually able to do what you want to do. Again, during the ICO craze, we've seen so many crypto startups that were promising the moon, and they wrote amazing white papers explaining and describing what they're going to do, but it had nothing to do with reality. It was not even possible to do. Now, don't get me wrong. Everything with startups is about changing what's happening. Everything around startups is about reaching new limits. But we always have to remember that we need to consider what's possible in reality. And in some cases, it's just not relevant at all. Doesn't matter how you turn it around. It's just not going to happen.
Mm-hmm. Yeah, that's true. And just to remind all the viewers that blockchain is still quite a relatively new sector, and the infrastructure is really lacking capacity in many cases. And plus, you also rely on a lot of partners on blockchain, node providers, blockchain providers, etc. So you can build great stuff. But then if some of your providers, the node fails or whatever, okay, I'm not a guy, but still even me started to understand these things after several epic fails in the startup world. So, okay, and speaking about legal part, which is also extremely important. And by the way, all the industry is discussing this Ripple lawsuit, with SEC, and nobody, well, not nobody, but not a lot of people expected this to happen with such a big, well-known company, after so many years on the market and so many billions earned, but still they have, I think, more than $1 billion fine right now to pay. It's quite painful. So how to avoid these regulatory complaints, or even better, because yeah, maybe you can't give the unique formula. But for example, I see a lot of startups now who say that, in order to avoid problems with regulators, we are making DAO. And since DAO does not belong to any particular jurisdiction, it is fully decentralized autonomous organization, then the regulators can't really find DAO because it is not regulated yet. How do you think? What do you think of this approach?
So first of all, it's not new, because since we are using the word decentralized, people keep saying that because it's decentralized, then it's not a security, and nobody will be able to complain and to investigate and arrest the founders. Obviously, we are seeing these days that's not the case, and we are seeing many of the ICO co-founders are being indicted by the SEC, and we're also seeing founders of decentralized exchanges being investigated right now. So whoever thinks that they're going to be using the decentralized term or the DAO term to avoid the regulation, I don't think that it's going to be relevant. And I think that many of them will find themselves in a huge problem in the next few years. Besides that, we have to always remember, using the term DAO doesn't make it a real DAO. It all depends on what happens in reality. It all happens in, just as an example, in the case of Uniswap, a very, very famous, well-known decentralized exchange in the industry, which is being investigated right now by the SEC. And one of the claims are that the founders of Uniswap actually made decisions when to list or when to approve a listing of a specific token and when not to approve. So if they're able to actually influence the operations, then it's not truly decentralized as they are trying to claim it is. I'm not saying anything against Uniswap. I'm not saying that they did violate any laws. I didn't research that enough, but I'm just giving you an example from the recent news that we've heard. And going back to your question, with regards to what to do or what not to do with regards to legal, we have to remember one important thing. Get consultation from legal advisors. Now, some people that are listening to us will tell themselves, of course, everybody needs to consult with a legal advisor before they start operating. Not in crypto. To be honest, most of the projects usually that I talk to did not get the proper legal consultation before they started. Now, don't get me wrong. In some cases, bootstrap startups cannot afford expensive legal advice. I completely get it. That's fine. Okay. Tell your investors that you are investing the seed or pre-seed round at the moment. You're not sure about the legal aspects yet, but as soon as you raise the initial funds, you are going to use some of them on proper legal advice. And then the co-founders should make up their mind and make up and make decisions based on the proper advice. Another thing that I see is that founders of crypto startups will not even hire a lawyer to create their SAFT, for example. So for anyone that is listening and doesn't understand what's a SAFT is a simple agreement for future tokens. It means that if an investor is supposed to get tokens, they invest through a SAFT, which means that they will get their tokens in the future after the token generation event happened. And in some cases, I see founders not taking any legal advice, just Googling SAFT, taking any SAFT that they found online without understanding if it's relevant for them, if it's not relevant for them. Now, we have to remember there are different jurisdictions, and even though crypto is meant to be global, and even though crypto is meant to be for everyone, and even though it's supposed to have no limits and no jurisdiction's influence, that's not the case yet. It might happen in the future. It might become much more relevant as time passes. But right now, it's not the case. And especially crypto co-founders must consider that there has to do a lot with their own jurisdiction, where they are based, for example. And another thing is where the investors are based. And one rule does not apply to everyone. Because if you are selling tokens to an American investor, or you're selling tokens to someone based in Korea, for example, it's completely different jurisdictions, completely different laws. It's not the same. And the last thing with regards to legal and tokens is the fact that things are changing all the time. Even if you got the advice yesterday, it doesn't mean that it's going to apply in a month or in 6 months or in a year from now. So you have to have a proper legal advisor that will advise you on a regular basis, including when there are changes in the different jurisdictions and the different laws. And also, it must be considered that one legal advisor is not always enough to advise for all of the jurisdictions, or even more than 1 or 2 jurisdictions. Because in many cases, lawyers are able to advise based on the country that they are based in, and they can't even advise outside of their jurisdiction. So these are the main parts of legal and token economics.
Thank you so much for trying to be so detailed in your answers, because exactly the problem that I see when founders are, even they are willing to get some legal advisor, but for example, let's take an example. Founders are based in Russia, and the crypto space is not regulated there. The investors of the startup are based in Asia, in Europe, all over the world. So there is no one jurisdiction where is particular lead investor taking over the majority of the round. And they do not know yet what jurisdiction is better for them. Of course, they Google, they check, and there are different listings. So they ask to recommend them some legal advisors. But then when they talk with lawyers, it happens that all lawyers, of course, they try to sell their jurisdiction. You talk with Swiss lawyers, you will hear that Switzerland is the best country on the world, for this. You talk with Estonia, it will become the best country, and so on and so forth. So founders get lost. They don't know what on this phase when they did not yet choose the jurisdiction for the legal entity. What should they do in this case?
That's very true. And also, we need to remember that legal advisors are service providers. And service providers, we are always interested in getting more clients. And sometimes they will actually give you a not honest opinion. And I'm talking about lawyers as well. Like any other service provider, it's exactly what you said. They will tell you, yes, come to Swiss. It's the best place for your crypto startup, because they are based in Swiss, because they can advise you based on the Swiss law. And obviously, I'm just giving Swiss as one example, but it can be any jurisdiction. And it's not necessarily the best jurisdiction for that specific crypto startup. And that's why I always ask any founders that I invest in, always ask a few service providers, always get a few opinions before you make a decision. And of course, if I'm involved, then I always offer them to consult with me, and I'll tell them what I think after they got the relevant different advices from the different service providers.
Another question is, how do you find valuation of the tokenized startup? Because for traditional startup, okay, it's still a subjective matter. It depends on many factors, and there are different models how to calculate startup valuation, but still there is some clarity. For tokenized startup, how do you find the valuation for tokenized startup?
Sure. So obviously, like traditional startups, you always have a few main factors for the valuation. You have the team, and according to the team knowledge, experience, and abilities, you can evaluate. You have, if they developed anything, yet, then that's the easiest way, because you already have something developed. It doesn't have to be a full product, but even if they develop the MVP or anything else, doesn't matter, alpha, beta, whatever it is, then it can influence. And the third part is, of course, and that's always relevant for any type of startup, is the type of industry, the type of specific, the niche specifically that the startup is relevant for. But the last part of my answer would be, in most cases, it's actually bullshit, to be honest. In most cases, it doesn't have anything to do with reality, and it can be exactly the same concept, the same abilities of the team, and the same tech, and you see one startup that is evaluated in this way and another one completely different. And when you're trying to figure it out, you will never be able to, because the co-founders will decide on the terms at the end, after they get the proper consultation, if they got any consultation. Sometimes they do, sometimes they don't. But the bottom line is that there's no real method to do this. It's all based on what the co-founders decided at the end.
I think your answer surprised many people, because a lot of people in this sector, they quite primitively say that the startup valuation is your initial market cap. That is how, which you put, that is it.
Yeah, if you want to hear about the bullshit that I've heard about the different ways to calculate, then you would be shocked. That's one of them, and obviously it's complete bullshit.
And by the way, how actually to decide for a startup? So when they build tokenomics, yeah, and normally this should be a bootstrapped startup who is already building some product, but they need, of course, to get funded. And funding is one of the important phases for majority of startups. And how should they approach the amount that should be raised? Because in some cases, founders want to secure the runway for the company for at least a couple of years in future, in order, if there is a bearish market or something like that. But some experts or investors say that it is bad approach, that the startup should earn from token model. They should have their revenue streams, and they should raise the minimum amount to make the token metrics sexy.
So absolutely not. And my answer is the following. First of all, we have to remember, I never saw one business plan that actually worked out the way that it was planned at the beginning. Let's remember that. And based on that, I will answer. I will give you my answer. So you always have to calculate exactly how much money you're going to need for all your expenses, the team, salaries, if there are salaries, because with crypto startups, it's not always the case, because the team gets tokens and they can sell the tokens periodically. So they don't really need a salary because they can enjoy the profits from the tokens. But let's put that on the side. So you have to calculate. And in some cases, you can come up with a number like $500,000, $1 million, let's say for 1 year. In other cases, it will be 5 million or 10 million, and the numbers can grow. It all depends on the startup itself and how much money you will need to build what you want to build. And the third part is you always need to make sure that you will have enough money and you will not be stressed when you are reaching the amount of the money that you need to spend. And you always have to consider that you will need at least a few months to do another fundraising in order to do the next round before the money runs out. And the reason that I told you that in many cases investors will say, yeah, raise the minimum that you need, I say absolutely not. Exactly the opposite. Because the investors that are saying it, they don't want to be diluted. So they want you to raise as little as possible. So the next round, they will already enjoy the growth of the valuation of the company. That's wrong. That's exactly the type of investors that you don't want. And I'm not saying that it's always wrong. Okay, don't get me wrong, but I'm just saying this as a rule. But it doesn't mean that it always applies. There are exceptions. And I would always prefer that a startup will have reserves and will not find itself in a position that it needs to shut down because there's not enough money because they raised the minimum possible. And with regards to crypto startups, let's remember that in most cases, you're raising for tokens. You don't even get diluted. Now, recently, we are seeing the concept of crypto startups raising funds for both equity and tokens. And I love it. I love it because the tokens allow you the liquidity, and obviously the equity allows you to be a shareholder, and it allows you to really have some kind of power and influence for the startup itself. Now, lastly, I would say that when you are raising the minimum possible, psychologically, you're always going to be stressed. You don't want the founders, the co-founders of the startup to be much more stressed than what they are already stressed about, because managing a startup is always stressful, and you want to minimize the amount of stress as much as possible. And this is one of the biggest stress factors for any startup.
Absolutely. We meet a lot of startups who are tokenizing their models from traditional world. And when I ask them, why do you want to tokenize? Some of them answer, because fundraising for equity is is horrible. It's the worst thing we can imagine. And yeah, everyone knows that. And you know, on InnMind, we work with a lot of traditional deal flow and standard terms. From the day one you start negotiating with investors to the deal closure, it can last 9 months or even 11 months or even 1 year. Yeah, while we see that in crypto space, it can be a couple of weeks or even days on the bullish market. So of course, it sounds very, very appealing to many founders. But at the same time, it depends. And now we touch a very sensitive topic with billions of questions about actually investors. Yeah, investors on the cap table. What investors do you want to see and what you don't want to see?
I know that many of the investors in crypto will decide on an investment based on the cap table, based on who else already invested. And I'm not one of them. Obviously, it helps when you have someone that is very well known. If it's an angel investor, if it's a VC, if it's one of the big crypto exchanges, one of the top 5, top 10, and so on and so on. But it's not such a big deal for me, because I don't think that it can actually influence on real projects. And I personally only invest in real projects. I will never invest in anything that cannot potentially become something real. And I've had so many opportunities to invest in scams or bullshit projects, and I never did it. Never did it, and I will never do it as long as me or one of my team members is aware that it's either a scam or a bullshit project. Because obviously we usually spot them, but I don't want to guarantee that it's not that we're always going to be able to spot them. Because we are, after all, human beings, and we can be fooled as well. Another part is, and obviously you can understand from my answer that I will never invest with scammers. So if I see a scammer, and there are scammer investors, by the way, people don't understand that we have so many investors that are calling themselves investors, but they're not real investors. In some cases, they made a fortune just by putting, exactly like somebody goes into the casino. They gambled, they threw some money on some coins or tokens, they became millionaires, good for them. But they are not real investors, definitely not professional investors. And they are pitching themselves as professional investors. Don't even get me started on the part that they promise to help the project and they're not able to help with anything. They can only damage the project. But that's another story. So for me, it's very, very important not to invest with scammers or with unethical investors. And also, for me personally, like I said before, it can be a plus if you have a celeb crypto investors or very well-known VCs. But on the other hand, it doesn't mean that they will help you. Because in some cases, you have these investors that are already invested in hundreds of different projects, and they will never have the attention for that specific crypto startup. So even if they tell you that they are going to help, or if you think that just because their name is on your cap table, it automatically means that you're going to succeed, that's completely far from the truth and from reality.
Plus, also, the top investors is also quite subjective term in the crypto space, yeah, because, for example, yeah, we have Sequoia and Pantera who are here for decades, yeah, or for how many years, I don't know, who were the earliest to jump into and really have very big name. However, yeah, Sequoia is very, has amazing reputation. Pantera, I don't know, they become a kind of spoiled, yeah, because every startup wants them on cap table so they can really dictate the conditions and squeeze the startup with allocation and other factors. But other funds, when I ask startups, well, when the startup comes to me and says, we keep some part of our allocation for the top VCs. And I ask, whom do you consider the top VCs? I always hear different company names. So there is no one list of top 10 VCs, and never rely on these posts in the media because most of them are paid or something like that, right?
Absolutely. So without commenting on the specific VCs that you mentioned, I'm commenting in general. So yes, it's exactly what you said. And I'll add on top of that, the fact that you need a startup in general needs to be very cautious about the investors' demands. Because again, in some cases, like, as I mentioned before, they can promise you the moon, but they will not do anything for you. And just because they have the brand name, they can ask you for more benefits and better terms. And it can influence your entire fundraising process in some cases. And co-founders need to be really, really careful about that. And again, either consider things very seriously and or get the proper advice from people that they know that they can actually advise them because they understand what they say and the advice that they give, and also that they are not advising based on their personal agenda and personal benefits. And beside that, we have to remember one more thing. And again, I'm not commenting specifically about the VCs that you mentioned. We have to remember that there are many entities from the traditional spaces that decided to go into blockchain and cryptocurrencies, or one of them, and they don't have any clue about it. They're just using their old brand name in order to get the best deals for themselves, but they just can't help crypto startups, for example, because they don't understand anything about crypto. And remember one more thing, and I am specifically talking about the big brands out there. In some cases, most of the partners, even all of the partners, and I'm talking about the GPs, they don't understand anything about blockchain or cryptocurrencies. They are hiring a specialist. They are relying on that specific person's advice or decisions, and they can't even review what they are saying. And that's very wrong, in my opinion. If you are not able, for example, with regards to funds, if the partners themselves, or at least one dominant partner, really understands blockchain or cryptocurrencies, I strongly advise these funds not to do it, because they cannot do it professionally as they have done it for many years in the traditional space. And they should do it following education that they did to themselves. They need to educate themselves first for a significant amount of time before they go into blockchain or cryptocurrency. And going back to what we discussed at the beginning today, when you are analyzing a project, if it's a blockchain or a cryptocurrency project, it's not enough to analyze everything that we have been analyzing for many years in the traditional space. You also need to analyze the blockchain that the startup is based on. You need to analyze the token economics and everything around the crypto startup if it's a crypto startup. And if you don't really understand that, if you're going to rely just on one person that you hired in your team, I don't find that professional, to be honest.
And plus also a small addition that when these big dinosaurs jump into crypto space, one harm that they can bring is to spoil the industry with the extremely high valuations of what happens quite often, that we see, and unreasonable valuations.
Yes, absolutely.
And since you elaborate on scam investors, I know you don't want to name names, but at least how a startup, there is no blacklist in the internet, and there is no clarity. And for many startups, it is the first contact with many investors in their life. So they don't have experience who is bad, who is good. All of them are very sweet guys before you sign this up and give away allocation. So how can a startup identify what are the red flags of scam investors?
So before I answer, no, I don't have any issue naming names. I've been actually doing it since I joined the industry, and I'm considered to be the scam fighter for many people in our industry, because that's all they know about me, and all they've seen is me calling out scammers. So I don't have an issue naming names. I just didn't want to comment on the specific VCs that you mentioned, because I never researched them personally. Or one of my team members, and I just don't want to comment on something that I'm not sure about. I only name names when I'm sure about something. If I'm sure that someone is a scammer, I will call out publicly, and I've done it actually also in front of scammers themselves while I was speaking on in events on stages. But to answer your question, red flags. First of all, like with everything, ask for recommendations. I know that it sounds crazy. I know that if you're talking to an investor, the last thing that you want to do is to upset the investor, because then your chances of getting the funds becomes lower. But it's like anything else. Ask to talk to people that these investors worked with. They are saying, for example, that they can help you a lot. Ask them to talk to other co-founders that they helped a lot. And not just one. Because everybody can find one or two persons to recommend you. And when you do talk to these co-founders that they said that they can vouch for them, always ask about the personal relationship between them, because you will surprisingly find that in many cases, when people are suggesting recommendations, it's the cousin, or the uncle, or the brother, or the sister, or anything else like that, or a high school friend from many years ago, and so on and so on.
Or sometimes even a lot of advisors, they get the percentage from the deal from investors, because investors are hunting for good deals. And I was also surprised when I learned about it. That's the case.
Yes, absolutely. Another red flag that I would, and obviously the first red flag that we were discussing now is if they can't provide any recommendations, especially if they're saying that they helped so much in the past, then obviously it's a huge red flag if they can't provide recommendations. And by the way, in some cases, you can actually see public recommendations. Everybody knows that LinkedIn recommendations is a common practice, but you also need to be cautious about that, because there's always the trading of recommendations. People come up to me all the time and say, please recommend me, and I'll also recommend you on your LinkedIn. My obvious instant response is no, thank you. If somebody wants to recommend, they should do it organically. and they should do it because they want to. And it's not a problem to ask for a recommendation, but don't do shady stuff like I mentioned now, because I've asked in the past from specific people to write a recommendation letter for me for this case and that case, and that's completely fine. But I didn't make them write, or I didn't give them something in return for it. The second red flag, I would say, is that, and maybe I should have said it as the first red flag. Google, the name. It's unbelievable that everybody knows Google. It's unbelievable that everybody knows how powerful Google can be. And that today, if somebody did something wrong, if someone has criminal charges against them, or anything like that, and so on, there are very good chances that it will appear on Google. And just to emphasize, don't review the first page of Google only. Review the first 10 pages on Google. And you will be surprised to find many things on the third, fourth, fifth page, and so on. The reason is that many people, especially rich people, can push down or hire someone, more accurately to say, to push down negative results about them in Google. There is a service for it, and rich people use it often in case that they have negative results about them appearing on Google. So that's the first or the second red flag, that it's so obvious, but so many people are not doing it. I show up to a meeting usually after I Googled the person's name or the company's name, and I reviewed at least the first few pages. I do it for a few reasons, not just to see the red flags, but also to get to know the company or the person better. And it's much more respectful if you show up to a meeting after you did that minimum research. It usually should take 10 to 15 minutes. Obviously not if you do it for the first time, but if you did it for a few times, then you get the hang of it and you can do it very, very quickly. And it's also beneficial not just to find red flags, but to have a much better and more fruitful conversation with that company or that person. The third and red flag I would say is that you always need to understand the main agenda of the person. So obviously for investors, most of the time it's about making more money. That's completely fine, and there's nothing wrong with it. But I would always advise co-founders to take money from investors that care much more than just making money. And again, I'm saying, don't get me wrong, just making money is completely fine. There's nothing wrong with it. Everyone wants to make more money, at least potentially, at least in theory. Of course, not everyone. There are people that are against making money, but that's another point. But let's say that most people would like to make more money, and it's completely fine. But if you can take money from an investor that cares much more about the progress of the industry, the progress of your specific startup, because I'll give you an example. Let's take something that is completely not relevant for crypto. If the startup is working on building a cure for a cancer, and the investor cares about that so much, besides just making money. Another example, because that specific investor lost a family member to cancer, then that investor will be much, much more valuable than taking money from an investor that only cares about making money, because they really, really care about your progress and about your success, and you want to take money from them. So that's the best example that I can give you. Obviously, it's a very dramatic example, and you don't need to look for these type of very dramatic cases always, but I use that example just to make a point and to make sure that it's clear.
Coming back to tokenomics, but in relation with VCs. So usually a startup has a couple of funding rounds. Let's say the seed round, when they are on very early stage, just kickstarting, and they need some fuel to kickstart the marketing, also to hire developers, etc. And then also the next round, A, B, whatever. In crypto, there is no this segmentation. Unfortunately, typization. We need to do some typization one day. So what should be the normal balance? Because I've seen cases when the difference of the price of the token between seed round and public round was X10 or X20. It does not have any real meat behind, any fundamentals. Some people say that the difference should be maximum X3. So let's say 1 cent, 2 cents for the second round and 3 cents for public. Is there any formula, any standard, golden standard, which you will advise?
So absolutely, there's no standard, and I don't think that there should be a standard, but I completely agree with what you said. With regards to crypto startups, it's practically a joke to do such, to offer such a huge difference between the different rounds. Because you said it yourself before, with crypto startups, in many cases, it can be oversubscribed within hours or days. So there's no real point in actually making any difference between the rounds at all. Now, don't get me wrong. I'm not saying that there shouldn't be a difference, because even if investors invested today, and there's been already a week, 2 weeks, a month from the day that the first investors invested, then obviously there should be a difference. It's funny to me that it happens when there's a few hours or 1 day difference, but let's say after a couple of days or a week, it's fine, and it should be like that. But following what you said, I think that it's extremely wrong to do 10x, 20x difference, and so on and so on. I'm not sure that the maximum should be 3x, and I'm not even sure that you need 3x, because maybe you can just do it similarly to what you said. Maybe you should do it 0.1 or 0.01, and then the next one is 0.2 or 0.3 or 0.02 or 3 at the end. That's completely fine, and it sounds logic. But if you do it 0.01 and then you jump to 0.1, that's crazy. That's I mean, it doesn't make any sense, and there's no real reason to do it this way. And again, besides making the first investors to have the best stake in it, and I don't think that's good for the crypto startup. But going back to what I said before, there's no real standard. And yet, maybe there will be in the future. And even if there is a standard now, it's not a real standard, because we didn't have enough time. It's as simple as that. We do need at least a couple of more years, maybe even 10, 15, 20 years to have these type of standards.
I think considering how fast it is, how rapidly it is developing in crypto space, maybe not 10, 20 years, but at least a couple of years is needed, definitely.
I'll tell you why I disagree with that. Because yes, things are happening in crypto so fast, but look at the real success of crypto. How many things are actually successful in crypto? How many blockchains did actually prove themselves until now? I can actually tell you that none, zero. Because even the blockchain of Bitcoin didn't prove itself yet as a medium of exchange. So it proved itself to be the gold, the digital gold standard. It proved itself to be the digital gold with beyond any doubt. If anybody says otherwise, they need to be really stupid or really don't understand anything about blockchain or cryptocurrencies. But beside that, give me one example of something that proved itself in the real world, not in our world, not compared to the previous blockchain that failed. To have real world applications that are actually working and are actually working for a while, not working for a few days, not working for a few months properly. You see, you need to think about it.
Not in crypto space, right? I mean, not for the crypto community, but for the mass adoption.
Yes, I'm talking about mass adoption.
Yeah.
Come on, take even Ethereum that I personally like. The biggest claim against Ethereum, for example, that it's definitely not decentralized. So who cares that everybody says decentralized, decentralized, decentralized? It doesn't make it real, because look how much of it is based on AWS. That's decentralized? Seriously? Of course not. And that's just one example. And the list goes on and on. Now, again, don't get me wrong. I am very, very much into Ethereum, for example. I'm not preaching for Ethereum. I'm not endorsing Ethereum. I'm not endorsing any specific cryptocurrency. I'm endorsing cryptocurrencies in general. But take that example. Did it prove itself in the real world? Absolutely not. Absolutely not. Period.
Yeah, and a lot of these pilots with the corporates, etc., to launch something big together with certain blockchains, many of them, they ended as a joke. A lot of hype, a lot of marketing, a lot of PR, and nothing at the end.
Exactly. And for some people, when a company raised hundreds of millions of dollars, or the company is worth, or the DAO is worth this huge amount of money, what does it mean? So what? I mean, WeWork, we talked about naming names. I'll name a name. WeWork, one of the biggest scams on earth. One big scam bullshit company that raised and was worth hundreds of billions, I think. It was, I think, a few billions for sure. I don't remember if it's a few billions, tens of billions, or hundreds of billions. Bullshit. It's not worth anything. So who cares about the amount of funds raised? That makes people be mistaken all the time. It's not about how much money was raised. Of course, it's one of the factors to show the success of the progress and the growth of a startup or a company, but it doesn't mean that it succeeded yet. Even in cases when the company exited, it doesn't mean that it was a success. It means that another company was interested in buying that company for all kinds of reasons. It doesn't mean that it's a success, because we've seen cases before of companies buying other companies, and the co-founders actually did an exit. So for them, it was a huge success. Again, in some cases, because in other cases, the bottom line is that they didn't get much out of it because of they were diluted again and again and again. But let's say that they did get a lot of it, and after a few months or after a few years, the company that bought their company shut it down. So does it mean that it was a success because they exited, because the co-founders became rich? No, it doesn't.
My God, I will definitely cut this part and do the special edition, like talking about real success versus this marketing bullshit. It's amazing. Thank you for telling this, because these kind of things, they're kind of not common to discuss. It's more common to discuss how big valuation the company reached, etc., etc. And coming back, and by the way, I got the thought, when you explained how should be the conditions built for different rounds with the VCs on private sale, this could be another red flag for scam VCs. If investors insist that they should make X10 or something like that at the IDO price, right? That means that this investor wants to exit as soon as possible. And maybe this is also the red flag.
So yes, it can be a red flag, but let's remember something very important. Let's remember that investors are investing in tokens for liquidity. I mentioned it before, and it's a very, very important part of crypto investments. And yes, you want investors to be with you for the long term, but let's be realistic. Let's be practical. If it's a VC, they need to make sure that their investors, their GPs and LPs, are making as much money as possible. One of the strategies should be to sell tokens as soon as they become unlocked. And for example, when I talk to startups, I tell them, you have to consider that every time that the tokens will be unlocked, we will be selling them. We are actually saying it to the startups. Investors that are saying that they will never sell the tokens in the first year or the first 2 years, that's a huge red flag. Because if that investor actually is planning not to sell the tokens at all for the first year or 2 years, that means that one, The investor doesn't understand how to manage investments and how to manage risk for the investments. And the second part, they are most likely lying. I didn't see many cases of investors that are actually holding to unlocked tokens or most of unlocked tokens for such long periods of time. It doesn't mean that it doesn't happen. It might happen, but in my opinion, that's rare.
But you touched an interesting topic here, because then how do we differentiate between so-called dumpers? And for those who don't know, dumpers are those, it is a kind of bad weather in the crypto industry of those investors who sell their part of tokens and harm the price of the tokens on the market. So what is, how do we differentiate then sane, smart investors who are selling to secure the profits for their LPs and dumpers? What's the difference?
Simple. Just ask the investor to give you 3 examples of tokens that they've been holding for the time, for the period of time that they are saying that they are planning to hold with you, with that specific co-founder. You will be surprised to see that they can't give you these examples. As simple as that.
But does it mean that all investors who are selling as soon as they get the token unlocked are dumpers?
No, absolutely not. I said it about us. We are selling the tokens when they become unlocked, not always, of course, depending on the market situation. But what I am telling the co-founders is that they need to consider that, yes, we will be selling the tokens potentially as soon as they become unlocked. It doesn't mean that it's wrong. It means that it's a part of your strategy, and it's not an issue because you do lock the tokens. Most of the crypto startups will lock the tokens for a period of 12 months or more. That's completely fine, and that's how it should be, and that's how the startup is being protected from and against the dumpers. And on top of that, I will also tell you that my advice to co-founders is to always spread the unlocking as much as possible, which means that I've seen many cases of tokens being unlocked on a monthly basis, for example. Don't unlock the tokens for all of your investors on the same day. Either you change it between the investors, and let's say that one investor is being unlocked on that day and another investor a few days later. Or another option is that you can also release the tokens on a daily basis. Investors will not be selling tokens every day. So if you release the tokens on a daily basis, at least many of them, I'm pretty sure that they don't have the time to start managing token sales on a daily basis, even if they're not doing it themselves and they're doing it with someone that they hire. But it still requires management. It still requires attention. Maybe they will sell it every few days, every week. That's the goal that the co-founders should achieve. When you are releasing the tokens, they will not be sold immediately by all of the investors at the same time.
And by the way, what do you think of the cliff? And for those who don't know, cliff is the period when you lock the tokens and don't give it to investors at all. So it is locked, reserved. So what do you think about this option?
So I definitely think that it should happen always, but I don't think that the time limit should be very long. For example, I think that locking the tokens, completely locking the tokens for a period of a few months, that's completely fine, and it should always happen. But if you're completely locking the tokens for a year plus, that's very wrong in my opinion. Having said that, I do think that the team members should be locked for at least a year or more. Not the investors.
Locked,
the team members.
Not vested, not vesting period, yeah, but locked.
I'm saying both. They should be completely locked for at least 12 months or more. And then they should start getting the tokens. And obviously, they should get the tokens periodically, similar to the investors. If it's once a month, if it's once a week, once a day, or whatever. But it shouldn't be all at once, of course.
But then isn't it contradictory? Because at the beginning you said that sometimes teams should not receive or does not receive any salary because they can receive tokens and sell them. And if the tokens are locked for 1 year for the team, then team will not have any opportunities to live on, to convert.
Absolutely. So absolutely. In these cases, they should get a salary. Absolutely. If the tokens are being locked, then they should get a salary if they're being locked for a long period of time. Or you can say that, for example, you can do all kinds of calculations. You can say that they should get a minimum salary and a small, very, very small portion of the tokens being released after a couple of months, for example, even after the first month or something like that. It's all a matter of playing with the numbers, of course. Mm-hmm. But yes, your comment is very, very relevant because you can't have the team members not getting a salary and the tokens are locked for a year or more because many of them will not be able to function.
Many startups, they maybe do not really estimate properly the value of their tokens. So at the beginning, they promise to early team members that they will have high salaries and plus also quite a bunch of tokens, well, with vesting period, but still released every month, etc. And then they get into trouble because early team member does not mean team member forever. People can leave the company in the middle of the way, and people cannot deliver, not perform properly. And then they already have this contract. They already have a lot of tokens. So how to approach this? How to protect actually the company, but at the same time motivate, make a healthy motivation for the team members in tokens.
What you said is very true, and some people would be surprised to know that it's really difficult to keep team members for long term in a startup. You know, it's very sexy to be a part of a startup, especially today. In some jurisdictions, it wasn't very sexy in the last few tens of years. Now it's becoming sexy in most of them. And people don't understand. It's not fun. It's hell. To be a co-founder is absolutely hell. You can forget about your personal life. You can forget about your hobbies. You know, in some cases, when I do due diligence and I interview team members, I'm asking them about their hobbies. I'm asking them specifically, are you willing to let go of your hobbies for the next 6 to 12 months? Maybe you will be able to get back to them. Maybe, and it's a big maybe. Sometimes they look at me like completely shocked. They're asking me, what are you talking about? Me giving up my hobbies? Never. Then I say, okay, good luck with your startup. Bye-bye. And we finish the call. It's as simple as that. You cannot have a life if you're a co-founder of a startup, at least for the first period of 6 to 12 months, maybe for years, depending on the startup. Now,
I can prove it. I am the founder of the startup 6 years already, and I don't have any hobbies despite a startup, business development and everything that can arise around the startup. And when people ask me and get shocked, they think I am sociopath, but that's the life. You should live it. Otherwise, all this advice on life-work balance and you need to work only the less hours you work, the more productive you are, etc., etc. I've never met a successful founder who really bootstrapped from the day one and build it himself without specific unfair advantages that may occur, who kept a life-work balance, so-called.
Absolutely. And don't get me wrong, with regards to employees getting salaries, I actually do believe that you can work less and be much more productive. It can happen. It happened to me personally with some employees that I hired in the past. But co-founders of startups, there's no such thing. And if you're not going to be completely dedicated to the startup, I am telling that to all co-founders and potential future co-founders, don't even go there. If you think that you're going to stop working at 5 or 6 p.m. like you did in your normal traditional job, forget about it. It's not going to happen. It might happen. The startup is doomed to fail. It's very simple.
coming back to this thing about vesting periods, etc. So, for example, for VCs, for investors, again, early investors who jump in with the highest risk, they already get a benefit of smaller price, better conditions. Later investors, they pay more to get in. But what about vesting periods? Should they be balanced, like equal for both rounds? Or I also heard a lot of opinions from investors, of course, that the late investors should get smaller vesting period because they already overpay for being late. What do you think?
Yes, so I definitely think that there should be a difference, but very similar to what we discussed before about the prices. I think that it should be a slight difference. There should be a difference for sure, but it shouldn't be more than a slight difference. And especially with, again, crypto startups, we are talking about different rounds within a few hours, a few days, or a few weeks. It's not that of a big deal when we're comparing it to traditional startups that sometimes raise money in a few years. So there's a huge difference. And again, I don't think that there's a standard for it. I do see a lot of similarities between the different crypto startups, but I think that it's only because most of them are copy pasting many things from others. And don't get me wrong, I'm very much against copy pasting in general, as you know. But again, some things you can copy paste. Sorry, I'll say it again. Some things you can be inspired from others. Don't copy paste. Do it by yourself, but you can have the inspiration from others, especially ones that succeed.
Mm-hmm. Inspire, but not copy paste, guys. This is very important because every startup is unique. Business model is unique. You can't just take tokenomics of NFT startup and replicate it to gaming startup or to DeFi fintech startup.
Then it means that you don't have a startup.
Yes. And just to finish the part about vestings and copy pasting, by the way, recently, so the first half of the year, there was no vestings for the public round, for the IDO. But around a month or a bit more ago, I guess someone, I don't know who was the first company who implemented vestings for IDO, for retail investors or backers. And then every second and then every first startup right now is asking also for vesting for the public round. Some people say that it is exaggerating because public round, usually the allocation per one person, per one investor is like $300, $200. But still, everyone tries to copy it. So what do you think of this?
So I actually think it's a good idea, but I think that the time frame should be as minimum as possible, which means that the locked periods shouldn't be more than between a few weeks to a few months. And when I say a few months, I'm not talking about 11 months. I'm talking about 2-3 months. That's something that I think is healthy. And I think that it is beneficial because of what you mentioned before about the dumping. Simple as that.
So you think it is healthy in order to minimize the selling pressure right after launching on exchanges, but at the same time, you should not approach it the same way as everyone right now does, 3 months, 4 months, 6 months. It can be a couple of weeks or a month or something like that.
Yes. Now, don't get me wrong. There will be many crypto people that will be completely against it. They will be against token locks in any way. But beside that, there will be many people that will be against specifically this, not token lockups in general, because then if you do a public sale, then it really needs to be liquid. If it's not liquid, it's not a public sale. So why are you calling it a public sale? But again, I think that it's healthy if it's going to be for very short periods of time.
Mm-hmm. Then coming back to the tokenomics design, so there are parameters, or how do you call it, segments of token distribution like team, advisors, investors, liquidity, partnership, marketing, etc. And in different pitch decks, I see some of them are similar, team, investors, liquidity, etc. And some of them differ. Some startups add bounty programs also in this token distribution thing. Some add something more creative. So do you think, is there any standard what you as an investor want to see and what you find healthy? Or again, it is really different and it is fully depending on the project's model?
So I personally think that there shouldn't be a standard. I think that it should be different between the projects. Again, I don't expect to see huge differences between most of the projects because they are being inspired from one another, and they are looking at what's happening in the market, and they are looking at the trends. And again, that's fine, that's healthy. I don't think that we will be seeing a standard, even if some investors will say that there is a standard or there will be a standard.
Mm-hmm. What do you think about the public sales on pre-IDO phase? What I mean here, some startups, they want to motivate community as early as possible, and they are making airdrops or sales of NFT or micro cards or whatever. Yeah, if it is in gaming sector, they are selling also some of their gaming assets early for the community. And I heard that many advisors and investors are really against of it because it kind of increases the circulating supply, and it increases also the selling pressure after the token will be listed. But others say that it is super healthy because it's all about community and not about only VCs on cap table. And how do you think?
So with regards to airdrops, I'm very much against that. I think that there are only a few airdrops that I've seen in the past that were actually relevant and were actually beneficial. Most of the time, it was just to create FOMO, and that would be a negative FOMO, in my opinion. With regards to the public sales, with regards to different IDOs and so on, I think that it's a must for every project. And I always recommend the co-founders that we are investing in to actually do a few of them. One, because of what you mentioned before, it's really small amounts. It's not supposed to influence that much. And the second reason is that we are talking about crypto. We do want to allow as many people out there to participate. Let's remember, crypto is for everyone, everywhere. If you do not do the public sales, even if the public sales are offering small amounts of tokens to be sold, then it's zero. Even if you do something small, it's much better than zero. And I always explain co-founders to do a few of them, because for the startups themselves, it's very good for marketing. And we don't need to talk about the fact that marketing is usually number one or number two factor of the success of any startup. So I'm very, very much into doing a few IDOs or any types of public sales.
Perfect. So not airdrops, guys, just underlining, summarizing what On just said. Airdrops, it's free token distribution, yeah? And public sale is obviously sale. So that's the core difference. When you do something for free, maybe you will have a lot of people you do not really want in your community. And when you sell something, even for very, very small price, small amounts, people are paying, they want to jump in a little bit more seriously. Coming back to the next question, which actually you mentioned yourself at the beginning, importance of liquidity. And here we have different understandings of liquidity of assets, liquidity of investments, etc. But there is also token liquidity on particular exchanges after the public listing, on DEXs or CEXs. And here we have a lot of questions every time we talk with the startups about tokenomics. They are asking what liquidity to put. So many of them have no clue, really. And which is even more horrible, a lot of advisors have no clue. And I heard stories about the golden standard to be a couple of hundreds per exchange. I heard other stories about a couple of millions, or as minimum as possible, at least 50,000 bucks. How should be liquidity calculated?
Okay, so yes, it's very important. And again, I don't think that there's a golden standard, because not only startups are different, you can't predict and you can't know what's going to be the liquidity situation for your startup. Nobody can, nobody, without any exceptions. So, okay, we don't know what's going to happen, but we do need to do something, and we do need to be prepared. So, like you said, in some cases, it should be a few hundred thousands, but in other cases, it should be millions. Sometimes it can even go up to tens of millions, because it's all based on the real liquidity. It's all based on the trading of the token or the coin itself. But you have to be ready for it. So I would say that if we still want to have a golden standard, even though I said that there isn't one, I would say that for cautious co-founders, I would recommend to have about $500,000 worth, specifically reserved for the liquidity operations. And I will say one more thing. Some co-founders don't understand that there is legit and good market making, and there's shady and scammy market making. And it's not wrong to do market making. It's actually a must for every crypto project, at least to be prepared to do the market making. And just to explain to the people that are listening to us, when you do market making, the basics is that if somebody would like to buy your token or coin, it is very important that they will be able to do it. But if nobody is willing to sell the tokens or the coins at that exact second, then the person that is trying to buy will not be able to buy it. And it's fine if it's not instant. Sometimes it can take a few seconds, sometimes a millisecond, a few seconds. Sometimes it can even happen after a few minutes. So it's fine if you are doing your market making in some cases and operate it in a way to make sure that you are having the supply and demand within a few minutes. Again, some people will be against what I just said, and it all depends on the liquidity, but it's fine for me. But you should make sure that it's happening, because otherwise it might damage your liquidity, it might damage the trading of your token or your coin, and you should be prepared for it. In some cases, when co-founders of startups discover that they need millions, but they don't have these millions, that's completely understandable, because in some cases you only raise a few millions, so you can't actually spend them on your market making. But there are solutions for that. You can actually get service providers to provide you with market making services and liquidity services as well. So there are such companies, and you can actually get these kind of services. And again, if you can't find these solutions, you can always decide that you are loaning money. And again, you don't need to take too much risk, but in some cases you can loan money in order to operate your liquidity and your market making. And that's why, by the way, that's not the only reason, but it's one of the things that make stable coins so popular on different crypto exchanges, because many stable coins are being used for liquidity and for market making, obviously for staking as well, but it relates and it's connected to one another.
Mm-hmm. And I heard that even some VCs provide this service, at least to exchanges and to some big companies. Yes. I don't know that if they provide this service to new startups of liquidity. I mean, do you know?
Yes, absolutely. It's happening. If you're asking me, it's not happening enough. I think that it should happen much more often. I think that crypto startups should have much more, many more opportunities for that. And again, it's a part of the industry that is growing and progressing. And I think that we will be seeing many more service providers offering these services in the future and in the upcoming years to come.
Mm-hmm. And you said there is no golden standard, but at least what is the logic behind liquidity? Because let's say the startup after IDO is planning to launch on a couple of DEXs and one SEX, yeah? And for DEXs, for example, there is a logic that the smaller liquidity you have, the more volatile is your price of token, but at the same time, it has more potential to grow. The higher liquidity is, the less volatile is the token, but the less potential to grow. So should it be small liquidity at the beginning and then adding more in a couple of months, or how should they approach it?
Yes, so absolutely, you should add, potentially, you should be able to add more funds to your liquidity pool as time goes by. Of course, the first month is always going to be less than the second month, and so on and so on. It doesn't mean that it's going to remain this way, because after a couple of months, it might change in a way that is not according to what I said now. But yes, the first month, the second month, third month, it's predictable what's going to happen in general. Having said that, and to answer your question completely in general, it's the same as you would ask me, what's going to be the price of Bitcoin in 1 hour, or what's going to be the price of Bitcoin tomorrow? And everybody that keeps saying that there's a golden standard and they know how to predict these things, yeah, it's a great story, but I didn't see anyone that can prove it. Exactly the same thing as nobody can really predict the price of Bitcoin. Nobody, with no exception, no one on earth can predict.
Mm-hmm. So at least 500,000 of reserve should be reserved for liquidity in the tokenomics. And then, since we do not really know when this money will be released, how to replicate it in the tokenomics with all these release schedules? You know, every investor asks now for this beautiful chart with the full token circulation for the next couple of years, yeah, where it is the balance is visual. So how to put liquidity then here?
So I don't think that it's possible to put that part in that specific graph that you were referring to, but maybe I don't know enough. And I'm saying it seriously. I just can't figure out the way that you should do it. I think that you should just set the total amount and say you are setting this amount for your liquidity and stick to it. And of course, yes, I said 500,000, but if the startup raised, let's say 1 million in total and not planning to raise anything for the next few months, obviously 500,000 is not relevant, and it's going to be 250,000 or something around that, not up to 500,000. It all depends on the amount of money raised in total, and it all depends, as we said, with regards to the crypto startup itself, what it is, and what's the plans with regards to everything else as well.
Mm-hmm. And by the way, you mentioned if the startup does not plan to make the next funding round in future. So do you mean that there is a possibility, even after public launch, even after IDO, for crypto startup to raise again, if in half a year, let's say, they understand that they miscalculated the things and they need more fuel? Is it possible to approach investors again?
Absolutely, yes. I mean, it can happen with traditional startups, and most definitely can happen with crypto startups. And again, it's extremely important to understand one thing. We are all human beings. We all make mistakes. We all make wrong calculations. Don't try to cover up your mistakes. Make them public. Go on your blog and publish the fact that this was the calculation, you miscalculated. Because of that, you are going to raise more funds now. Get the support of your community instead of doing something shady or to cover up things and not talk about them. That's the worst thing that you can do. The worst. It's completely fine to make mistakes and to say, I'm sorry, we made a mistake, we want to correct it. It's completely fine.
As an investor, have you invested in such cases? Because I was talking to a couple of VCs about similar situations. Because we were approached by startups who launched IDO and on DEXs without thinking properly on the fundraising and runaway. And then they got in trouble in half a year. And the VCs, I asked, they said that they consider only startups that show amazing performance of their token on the market, of their traction, etc. Only then they consider jumping in the middle with some discounted conditions.
So no, it didn't happen to me as an investor, but it did happen to me as an advisor. And when I joined a few crypto startups as an advisor about 4 years ago and 3 years ago, I discovered after a few weeks or a few months that either they lied to me about specifics or they completely got things wrong. And when I found that they did things wrong, it was only relevant for me on how they responded to these findings and my criticism. If they went public with their mistakes, I remained as an advisor. If they didn't go public with their mistakes and they tried to cover it up, I left the advisory role. So it all depends on how they approached the problems. And with regards to the investors that you mentioned, again, it didn't happen to us, but in our case, if we would be an investor and we would find that, as I mentioned, if they are not trying to cover up their mistakes, I am not going to be negative about it. I am going to only try to help them, nothing else. But if they are trying to cover it up and lie about it, it's game over for me.
Mm-hmm. Okay, that's clear now. Short question about listing on exchanges. Do you think it's worth paying listing fee in order to be listed in one of the very well-known centralized exchanges?
Absolutely, yes. It all depends on the pricing.
Mm-hmm. I know that a lot of exchanges ask for quite a significant listing fees, 150K, 200K, and even more. So
yeah, you have some of the top 5 or top 10 exchanges
yes,
that are asking even millions for that.
Mm-hmm. So
no, I think that's very wrong. Very, very wrong. And obviously, I would advise startups that we invest in not to do it. But if it is 100K, 200K, 300K, depending on the exchange, depending on the user volume, the traffic volume, and the other factors with regards to the exchange. And by the way, most of them are not just faking trading volume, but also faking website visitors, unfortunately. So yes, if it is real, if it is valid, if the numbers are good, absolutely yes, it can be very worthwhile to pay in order to get that listing.
And by the way, speaking about faking on exchanges, guys, On with his team made a great research about crypto exchanges and possible scams there. So in the description of this video, you will find the link to the research by Cointelligence on the crypto exchanges, which you should stay away from and which are really good ones. So check the description of the video. Considering the time, the last one of the last questions from my side, you mentioned that everyone does mistakes, and obviously in the tokenomics as a business plan, yeah, I also never saw that business plan meets the reality, at least even on 50%. So as an investor, how do you consider when after you sign the deal, sign the SAFT, and then project comes back to you telling that we made the changes in tokenomics or investing period or something else?
That can't happen. It's great that you asked me, because there is one specific crypto startup that I'm actually discussing exactly that with them right now. And it's very, I'm very strict about that. You cannot make changes after the agreements were signed. It's completely fine if you want to delay the TGE, the token generation event. I'm not going to complain to any crypto startup about that. But if you are changing the terms for the investors after it was signed, that's not acceptable. You can approach the investors and ask for their approval to do changes, and in case they agree, that's fine. And the reason that I told you that there is one example of a crypto startup that I'm talking with them about it right now, is that I explained to them, we are not going to sign on the SAFT agreement unless you change the paragraph explaining exactly that, because right now the agreement allows them to do any changes whatsoever, whenever they want, however they want. And by the way, there are a few investors that already signed on that agreement. Going back to what I told you before about so many investors don't understand anything about what they're doing in our industry. And that's very wrong in my opinion. And as soon as the TGE happened, then obviously that's supposed to be based on a smart contract. They're not even supposed to be able to make any changes after the TGE. And if they are able to make changes, it means that the smart contract has a hole in it, which is not supposed to be the case.
But you agree if the startup coordinates with you in advance, if they found mistakes?
Of course, yeah. Of course. Mm-hmm. Going back to what we discussed before, whatever can help the startup, I will consider very, very seriously. Mm-hmm. But if co-founders of a startup decide to make changes against an agreement, not in accordance with an agreement, and against what was agreed, or they will ask us to sign an agreement that allows them to make the changes, the answers will be, sorry, no.
Gotcha. So guys, just elaborating specifically on this, please be as much communicative as possible with your VCs. Good VCs are your friends. They won't fight against you because you are building the project that will bring them a lot of money. So please consider your communication seriously. I see so many cases when startups, they really try to solve all the problems internally. Even not the whole team, but only founders. They're thinking, have sleepless nights, etc. And then they make some decisions, and then they have even more troubles to communicate these decisions. So the earlier you communicate to investors, the more transparent you are with them, the better for you at the end of the day. It will save a lot of time and a lot of nerve cells for you. Guys, if you want the second part with the continuation, please leave your comments, leave your questions in the comments. And don't forget, of course, to share this interview. And do you want to say something? Maybe I forgot some important questions, though I asked you only half of the questions that startups have sent me. But maybe you want to say something specifically on this topic.
Yes, absolutely. So we discussed before the fact that co-founders should forget about personal lives and hobbies and so on. And I will say it again and again and again. But I do have a message to potential founders of startups. Do it. Don't think twice. If you really think that you can dedicate yourself to a startup, do it. If you're being told that you're not good enough, if you're being told that you're not relevant for the high-tech and startups industry, that's very wrong. Everyone can be a co-founder of a startup. It doesn't matter who you are. It doesn't matter where you are. It doesn't matter what's your education. It doesn't matter what past experience and abilities and whatever you have. If you want to be a founder of a startup, do it. Obviously, if you don't have the right experience and the abilities and so on, maybe you should decide to take a small part in the startup, or maybe you should be ready to dedicate most of your time to study and learn before you create the startup. But don't think that if someone tells you, oh, don't do it, you should go and work in a traditional job, and so on, that can be very misleading for some people. And I can tell you from my personal experience, I had a great mentor, one of my best mentors, about 20 years plus ago. And that specific mentor, when I told them that I'm going to get much more involved in the high-tech industry, because back at that time, I wasn't involved in the high-tech industry. I was focused on my business back then, which was completely not high-tech or startup related. And he told me, you have nothing to do with high-tech. You have nothing to do with the startups. Obviously, he was extremely wrong. And it's very good that I didn't listen to him, because I didn't listen to him about other things that he advised me. If it's something that you feel, if it's something that you think, do it. Do it in a proper way, but do it. And don't let anyone tell you that you can't do it and you can't be good enough and you can't succeed and so on and so on. Just do it. And if you can dedicate yourself and do it.
Oh, On, thank you very much for this very, very inspiring end of the conversation. And here you definitely beat the Elon Musk, who said that if the founder should be motivated, it is not the entrepreneur. He shouldn't be the founder. So listen to On Yavin. Don't listen to Elon Musk in this in this regards. And best of luck to you guys with your startups development. And On, thank you very much for your time, for your wisdom, and for your advice. This is priceless. This is the gold mine of value for the startup founders. Thanks a lot.
Thank you very much for this today, and looking forward to do more of this in the future.